Okay, hi, I'm John McGloin. I'm the CEO and Chairman of Amara Mining. Just like to say thanks very much to the conference organisers for inviting me along today. And I'll take you through a short slideshow. How long have I got? Is it 15 minutes? 15. Okay, so I'll try and get through it quickly so that I've got a chance for questions, which hopefully there'll be a few at the end. Okay, so you can read that if you want. Okay, I'll just to put it into perspective on the gold market at the moment. I'm sure many of you are, well, hopefully some of you are investors, long-suffering investors. I think if you're in the gold market for the last few years, I think if you look at, I gave this, which is a worry. I gave this talk or this same slide a year ago, and I said it was about to turn, and it obviously hasn't. But if you look at where the gold price sits now relative to the gold stocks, you can see that we are at a very, very deep point. Many gold companies are deeply discounted in the current bear market, much deeper than I've ever seen it before. And particularly under juniors. So the last time that juniors sort of went into a nuclear winter was after the Break scandal in the mid-90s, and that basically scared the life out of most investors, and they wouldn't touch gold, and particularly wouldn't touch gold juniors. But now it's far worse. So gold companies are trading at significant discount to where the gold price has gone. And I guess that if the question is what's going to change, why what's going to drive up my company up, or what's going to drive other companies up, and not to be too clear, but it's really that you're going to have more buyers than sellers. And the issue at the moment is the opposite. There's more sellers than buyers, basically because the market is being driven on sentiment. So I think you probably need to see some turn in the gold price to see a turn in the gold companies themselves. Although I think that there are many gold companies out there that are offering very, very good value despite the deep discount in gold price. Okay, so enough on gold. Amara Mining, we are based in West Africa. Our principal asset is the Yaouré deposit, which is in Ivory Coast. Ivory Coast is a very, very benign country in West Africa. I would argue it's one of the better places to be as a gold explorer. It's very underexplored. There are 4 existing operators there. The country, when it got following independence in the 60s from France, basically drove its economy on agriculture, not on mining, as many African countries did. So it has a life outside of mining, which as a miner is a great thing to see, because it means you're not the first port of call when the government wants to raise taxes and wants to raise money. So it's a great place to be, and the country now is trying to develop a gold industry or a mining industry, and has put in place very compelling tax breaks to encourage exploration, and therefore to encourage mining on the back of that. In terms of where the country has gone and what it's done, it's got a very strong electrical infrastructure, which in mining is a real boon, because one of the most expensive things in mining is generating power. So if you can draw that from the grid, then you can basically break even at a much lower gold price than you can see in other places like Australia or elsewhere in West Africa. It's got a great road network, and it's got quite an educated workforce as well. All things which are very positive for or very give assistance when you're building a new gold mine. When you're looking at a company, obviously one of the key things is who is running the company. Do they know what they're doing, and are they committed to what they're doing? We have a very solid technical team involved. Myself, I'm a geologist, worked in Africa in the early part of my career. Then went across the docks. I worked as a banker for a number of years, and then came back to mining in 2012 when I joined the company. Peter Gardner, his background, he's actually a geophysicist, but for his sins he became an accountant. It's a more exciting life, I guess. And he is, he's been involved in banking, very solid guy, very safe pair of hands. Our technical team, Nigel Tamlin is a mining engineer, a lot of experience in West Africa, works on a number, initially I think started working in South Africa in the gold mining industry, and then subsequently worked in in Ghana and throughout West Africa. So he joined the company approximately a year ago to assist us as we take the company forward through a pre-feasibility study. And Peter Brown is our exploration geologist. He lives in West Africa. He has been the key power behind us growing our resource base in Ivory Coast. So over the past few years we've gone from 200,000 ounces to where we in 2011, 2012 to 7 million ounces, and that's been on the back of Pete driving that exploration program. Our non-exec directors are fiercely independent. The two guys on either end of the column there. Henny is the CEO for Anglo American Copper, and Alex Davison was a past exploration manager for Barrick Gold. Peter Hain was the Minister for Africa in the Tony Blair government when they went into Sierra Leone, and Jeff Stanley is ex-gold analyst with BMO, and previous that was a geologist. Peter Calley, you may know, he was chairman of Banro and Loncor, and prior to that was chief exploration manager for Ashanti Gold. Okay, so I think like the graph there in the bottom right really tells the story behind Amara. I joined the company in 2012. I got the company to focus on exploration at Yaouré. There was one rig drilling there at the time. I doubled the number of rigs, we drilled it out. We took a deposit that had been mined for oxides. Initially by the French, they mined, I think, 3 million tonnes at 3.9 grams a tonne. Subsequently, Clough Gold, which was the precursor to Amara mining, mined the Yaouré Central deposit. They mined, I think, 2 million tonnes at around about 1.1 gram a tonne. Both companies had ignored the underlying sulfides. I drilled the sulfides out with Peter Brown and the team. We took the resource from 200,000 ounces to 6.3 million ounces, and then to 7.3 million ounces. We've closed the spacing down. That 7.3 million ounces now, 70% of that is in measured and indicated. So I'm going to take you through the story of what we've done, and try to explain why the share price sits at an all-time low, which I find quite flabbergasting. Okay, so we put out our pre-feasibility study earlier on in the year based on the drilling that we'd done the previous year. So we drilled 80 kilometres of diamond core. We built up the resource. Now, when we did the PFS, we had put out a PEA earlier on and we'd shown phenomenal economics, and that PEA had been based upon a pit shell of $800 per ounce. When we moved to the PFS, the rules behind putting a PFS out, you can only use measured and indicated resources in a PFS study. So the measured and indicated resource, using that alone meant that we had to go to lower the cutoff and go to a higher gold price shelf. So the reserves were then stated inside a 975 shell. So the grade of those ounces was 1.18 grams per tonne. So that really pulled some of the economics back that we had shown in the earlier PEA. So what we did then was last summer we put in another 11,000 metres of drilling with further test work to move, the target being to move the ounces, or more of the ounces into the higher confidence category measured and indicated, and to lift the grade. And we also wanted to bring the capital down. So we've achieved the first two things in that, which we showed earlier this week actually. We have now gone to 7.3 million ounces, but inside an 800 pit shell, we've got 3 million ounces at 1.6 grams per tonne, and there are 60 million tonnes. So we can now run our economics at that higher gold price. So as we go forward through the rest of this year and into next year, that's what we're going to do. We're going to show you what those economics look like. So we will restore the positive economics that we showed in the original PEA. And this slide here basically shows you what happened as we drilled out. So moving from the left-hand side to the right-hand side, the left is the before, the right-hand side is after. We knew from earlier grade control drilling in the pits that we had some high grades near surface which were not being picked up. So what we did was we pumped the pits out and we put further drilling in, and you can see, if you look in this area here on the other side of the slide, you can see where we picked those higher grades up. So those higher grades are now near surface, which means that we can get those into the mill early on. So when you look back at what we said the capital requirement, upfront capital was for the 6.5 million tonne case, we said it was 447 million. 33 million of that was pre-strip. So the intention is to bring the pre-strip back. 107 million of it was on a fleet. We believe that we can make the fleet smaller or go to contractor mining, so we can pull that out. So we believe we can bring the capital down to something beginning with 3, something between 300 and 350 in a slightly smaller mill, but retain the gold output. So we should be able to do something that will produce over 200,000 ounces for 10 years inside a 850 pit shell with a grade close to 1.6 grams a tonne. So that means in this gold price environment, if you run our model at $1,000 per ounce, you should see an IRR of 20%. You know, and that, you know, if we can do that, this will be a pretty unique deposit in terms of what's being developed in Africa, but on a worldwide basis. So we've got a real standout deposit here. In fact, this discovery, this 7.3 million ounces, is the largest discovery in Africa in the last 10 years. It's something like the 60th largest in the world in the last 15 years. It's a significant deposit with good grades in a country that is benign and wants to see development. Which I think is basically what I'm saying on that slide there. So we absolutely believe, as we move forward through the optimizations on the feasibility study, that we can bring the capital down and we can restore those economics. Is that going to lift our share price? God knows. To be perfectly honest with you, I'm surprised that the share price came down this week when I put out an announcement, which I would argue is probably one of the best announcements that any gold company's put out. You know, I would have said, like, you know, the catalyst to see the share price going up would be a resource upgrade and further economic announcements. But you know, in this market, to be honest with you, I despair. I don't understand. And all I can do is, you know, continue to control and take control of the things that I can, which is, you know, drilling, resource announcements, and move the company forward. We've got a pretty strong exploration portfolio in around the mine. I think we're in a pretty strong place in that time. So look, I'll stop there. We have Balmahan, which it has zero value in our portfolio at the moment, and that's it. More than happy to take questions. I'm probably out of time, right? Okay, I've got 1 minute, but I am on the stand, so, like, you know, if you don't want to ask a question here, but if you do, more than happy to take a question.
Have you had any talks with Mangold? I mean, sort of JV or anything like that?
Yeah, we have a, like, you know, what I've said, I think I've said this here before, but what I've done is, you know, I haven't been relying on the market to take this project forward. So we have a data room, and we have a number of people in that data room. The idea being that, you know, as we get through to the point where we need to finance this, and we find that the market is dead, that we can potentially go out and look for a joint venture partner. So yeah, we have had talks. I'm not sure whether they're in the data room or not, but yeah, we have had talks with, you know, if you look around, all the usual suspects. So, you know, we are looking at that as a potential route to finance. So, yeah.
What is your current debt situation, and what are your capex projections for the next year?
So we have no debts. We've got, at the end of June, I think we told the market we had $13 million in cash. We've basically stopped drilling at Yaouré now, so we're in a pretty low spend regime, and we think that we've got enough cash to basically take us through to June of next year.
In terms of sustaining this 200,000 production a year, what are your capex projections for the next year?
I'm not in production. I'm in exploration at the moment. Anybody else?
Thanks, John.
Thank you very much. And I do understand, so if anybody